Hello friends, today's topic is BEPS Action Plan number 4, which is Limit on Interest Deduction, wherein we will discuss the issue surrounding the limit of interest deduction, the limit applicable on the interest deduction, what are the OECD recommendations to address this issue, and the corresponding India tax provisions on the BEPS Action Plan number 4. So friends, action plan number 4, BEPS action plan number 4, limit on interest deduction, wherein the deduction of interest in the books of accounts of the SSC will be limited, will be subjected to a cap, only because such interest deduction is been effectively used to reduce the tax profit, wherein, for an example, a company is taking excessive loan from its holding company or other associated company. It could be vice versa. Intra group companies are taking loan amongst themselves in order to reduce the overall tax liability. Also, in an overall group company, there might be issue could start. There might be a case wherein the loan amount is more concentrated in a country where tax rates are high, so that they are able to take deduction of interest and to reduce the overall tax liability. So, two practices we have discussed: intra company loans, and second, loans in M&E company are more concentrated in a company in a country where taxes rate are high, and they are effectively in a way transferred to a tax haven country. So, to curb these practices, OECD has come up with practices recommendations suggested in BEPS Action Plan number 4. On your screen, interest deduction and other financial payments, BEPS Action Plan 4, locating third party debt in high tax countries. These three are the example through which interest deduction is being effectively claimed by entities. Interest deduction or other financial payments which are eligible for deduction. So first is locating third party debt in high tax countries, meaning in a group company, country where higher tax rate is applicable, that company is borrowing loans effectively to reduce the total tax rate. Second, using intra-group loans to achieve interest deductions in excess of the group's actual third-party interest expense. Right? So intra-group loans are structured only to reduce group's actual third-party interest expense. So intra-group loans are structured in such a way that overall tax expense are reduced. Last is using related party or third party debt to finance the production of exempt or deferred income. So one intra-group company is financing other company by taking a loan. So these are one of the examples, issues, practical issues which has been addressed by action plan number 4 through recommendatory measures. Recommendations for the design of domestic rules to prevent tax base erosion through the use of interest expense and other financial payments that are economically equivalent to interest. So recommendations are to improve the domestic rules, design the domestic rules in such a way that it prevents tax base erosion through deduction of interest or similar payments. Common approach: linking an entity's net interest deduction to its level of economic activity. So the approach suggested by OECD is you cannot deny entirely the interest deduction. However, you can link it to the economic activity, you can link it to the sales of the respective entity. So whatever is the interest deduction, if it is in sync with the sales activity, in sync with the economic activity of that particular entity, then you will be allowed interest deduction on it. It's only that, cut start, it's only that it should have some correlation with the sales activity of the particular entity. If yes, then interest deduction won't be denied. If no, then boss, there is a cap on interest deduction. Right? So this is the common approach, and in this approach it includes three elements: fixed ratio, which is nothing but denominator as EBITDA. EBITDA is nothing but earnings before interest, before tax, before depreciation and amortization. So whatever are the earnings will be denominator and numerator will be interest. So in proportion to EBITDA, you will be allowed interest deduction. Group ratio rule, in which if there is a positive, cut start, if there is a positive prospect of the entire group company, then interest deduction will be allowed. So group ratio, in the case of group ratio rule, the overall ratio of the entire group company will be considered and deduction may be allowed to the SSE. And last is targeted rules, wherein which are specific to a particular risk. So based on a particular risk, rules are made, and accordingly targeted rules, specific rules to address the issue of deduction of interest or other similar payments. So three elements, friends: fixed ratio based on benchmark net interest EBITDA ratio. This ratio has been adopted, cut start, this ratio has been adopted in India as well. A group ratio rule allows entity to deduct more interest expense based on the position of its worldwide group. So for an example, 100 is the total interest paid. So based on fixed ratio, net interest to EBITDA, we are eligible to only 70 interest. Agreed, you will only get interest deduction of 70 based on the nature of economic activity. In the second example, group ratio rule, 100 deduction, 100 interest amount has been paid, and as per the group ratio rule, you may be eligible for more than 70 interest, more than interest of rupees 70. In an example, if the overall group ratio, which is global level, worldwide level, is positive, then interest expense will be allowed as 100%. Right? So based on group ratio rule, wherein position of the worldwide group will be considered for deducting interest, and last is targeted rules, These rules address specific risk. So friends, we have studied examples of interest deduction and recommendations of OECD to design domestic rules to prevent such practices, and common approach. There are three approaches to it: fixed ratio, group ratio, and targeted rules. India chapter, as we have discussed earlier, India has implemented fixed ratio and introduced provisions of Section 94B to address the issue of interest deduction. As per Section 94B, there will be a cap on interest deduction at the rate of 30%. At the rate of 30% of interest income divided by EBITDA. 30% of EBITDA, no ratio is adopted. However, it is limited to 30% of EBITDA or interest expense, whichever is lower, will be allowed as deduction to the SSC in the year of payment, and the cap of interest rate and the threshold limit. Threshold limit is nothing but it is applicable only if the total interest payment is more than 1 crore, and also carry forward concept would be that the 100 rupees interest paid by you, only 70 is allowed, which is 30% of EBITDA, right? And rest 30 rupees will be carried forward to the next, will be carried forward to the succeeding previous year till 8 years. It can be carried forward, meaning as per Section 94B, you will be allowed interest deduction to the extent of economic activity, to the extent of EBITDA, 30% of EBITDA. Rest you have to carry forward to the succeeding previous year. Maximum that an interest can be carried forward is 8 years, and threshold limit of 1 crore, below which there will be no cap on interest deduction and entire interest amount will be allowed as deduction to the SSC. So friends, in their chapter, in line with the recommendations of OECD BEPS Action Plan number 4, Section 94B has been inserted by Finance Act 2017. So 94B, it provides a cap on the interest expense payable to associated enterprises. So intra-firm expenses, intra-firm loans, wherein an associated enterprises, wherein a non-resident associate enterprises are providing loans to a resident Indian company or to a non-resident who has a PE in India, permanent establishment in India. So the borrower is Indian resident or a non-resident having a PE in India, or and the lender is the non-resident associated enterprise. So a cap on the interest expense payable to associate enterprise, total interest paid in excess of 30%, excess of 30% of its earnings before EBITDA, earning before interest, taxes, depreciation and amortization, or interest paid or payable to such associated enterprise for that previous year, whichever is less shall not be deductible. Anything in excess of 30% shall not be deductible. Borrower is Indian company or foreign company having a PE in India. Lender is non-resident who is associated enterprise of borrower company. Deemed debt. Deemed debt is nothing but if any guarantee is provided if any guarantee is provided by the associate enterprise, by the non-resident associated enterprise on behalf of the Indian borrower company, then also such guarantee will be deemed to be as a loan provided by the SSE, loan provided by the non-resident associated enterprises. Provides an implicit or explicit guarantee to the lender or deposit a corresponding and matching amount of the funds with such lender. Either you are providing guarantee or you are depositing funds, a matching amount is been deposited with the lender. Indirectly, funds are provided by the associated enterprise only, but only through a different entity. So even if a guarantee is provided or funds are deposited with the third party lender and that third party lender is providing funds to the Indian company, to the borrower company, in such a case it will be deemed to be a debt, and accordingly interest paid by the borrower Indian company to such third party lender will be eligible for 94B limit of interest reduction. So we have seen that here in bullet number 2, cap on interest expense payable is applicable where interest is payable to associated enterprise. So even in the case of deemed debt where guarantee has been provided by non-resident associated enterprise to the third party lender, where funds are provided, funds are deposited by the non-resident associate enterprise with the third party lender, and such third party lender on obtaining guarantee or on obtaining funds is providing loan to the Indian borrower company. In such a case, loan by the third party lender will be deemed to have been given by the associated enterprise only, and accordingly 94B will continue to be applicable. So loan provided directly or indirectly by an associated enterprise will be eligible for 94B limit on interest deduction. And carried forward, as we have discussed, it will be allowed till 8 assessment years to the extent of maximum allowable interest expenditure. Meaning, this sentence is, let's say 30% has been disallowed, it has been carried forward to the next assessment year. Now, the cap 94B, cap on interest reduction, will be recomputed, and as per that also only 70 is allowed, right? So effectively if we see 30 of previous year 1920 and in the previous year 2021 also there is excess of 30 amount. So it is not that 30 is bound to be allowed. It will be limited to the maximum allowable interest expenditure. It is not that if 30 is carried forward, it is the over and above limit, it will breach the limit of 70 rupees. It is not the case. The interest deduction will always be limited to, let's say, 30% of EBITDA. It can never exceed that amount, even if you have any brought forward interest deduction amount. So year on year, this limit will be applicable. It doesn't matter if you have carried forward interest amount or not. Threshold limit: interest expenditure should exceed 1 crore to for Section 94B to be applicable, banks and insurance business are excluded from Section 94B. So friends, the India provisions, Section 94B has been made applicable in line with BEPS Action Plan 4. BEPS Action Plan 4 is nothing but limit on interest deduction and other financial payments which are related to such interest payment. This concludes Action Plan number 4. Thank you.